Welcome everyone, Michael here with Offshore Citizen. Today we're going to talk about a common, or maybe not so common, but definitely important tax failure, something that people make a mistake on with respect to an international company. And so this is super important because the objective is to be tax compliant, to legally reduce your taxes as much as possible. And if you don't know the laws, or you don't follow the laws or something like that, that can get you into a ton of trouble. And so we're going to cover something right now that I had a client ask about earlier today. So let's dive in and discuss it. Before you do, if you haven't already, please hit the subscribe button, hit the notification bell. Thank you for being here. I'm Michael. If you're not familiar, international taxation and relocation is the specialty of Offshore Citizen. And so if you're interested in help with that, you can reach out. You can either book a call with me, calendly.com/Rosmer, link in the description below, or you can go to offshorecitizen.net and you can send a message through our website and communicate it with us there. Okay, thanks. So jumping in, the very common thing that happens when people reach out to us is they have sort of two frames that they might come from, which are more or less similar. They're saying, hey, I'm thinking about setting up a company here, or I think I need a company here. Alternatively, they'll say, where should I set up a company? And as I mentioned in many videos, and I try to kind of reiterate over and over again, there's like a few sort of, if you understand international tax, then there's kind of like some common recurrent errors that people make. So the first one is, for the most part, there's like 10 countries and the country is really not the important thing, okay? That's really not the important thing. The important thing is you need to understand the rules. The rules will determine this other stuff, and forming a company, I would say, if it was as easy as setting up a company in BVI and paying no tax, everybody would do it and the tax department would be out of business. That is not the case, okay? It is absolutely not the case. You will get yourself into trouble. You will have to pay taxes, etc. It's not good. You need to understand what the rules are, understand, okay, what is necessary to work around those rules. Very, very important, okay? Very, very important. Those rules, by the way, vary by country, which is why, we have to be experts in a whole bunch of different countries and understand how they work together and all this sort of thing. The second thing is you want to make sure that you are in a situation where, in addition to understanding what the rules are, you want to understand kind of how the substance goes behind that. So both of these points are really key. So here's the thing that happened today. So we have clients from all over the world, setting up structures all over the world, etc., and we kind of work with them. And so this particular client has a structure going well, etc. And they said, oh, hey, I was interested in getting an office lease in this home country. Is it a problem if I do that through my foreign company? It's like, yes, that is absolutely a problem. It's absolutely a problem. Do not do that. So let's understand the big thing we want to reinforce again and again and again. Understand the rules. What are the ways that a foreign or that a local government can tax a foreign country? Okay. Number one, they can do so based on the residency of the company. Okay. Residency is not place of registration. Very, very important. Okay. Very, very important. Often it has to do with this thing, management control. No, I've done some videos on it. I will talk about it in future videos. Anyway, that's very key. Second thing, and this is where we come into, is they can always tax foreign companies on local source income, okay? That is always going to be the case. Now, an important thing, you have to be really careful because, for example, I had a client not related, this is before they came to us, they had a situation where they had set up a company and they had a nominee on the company in a country that was relatively high tax. Now that nominee notably did nothing, okay? There was no actual involvement from that person, but in the absence of something else, the tax department pushed on them and said, oh, hey, you have to pay tax in this country, okay? So really, really important to understand how you can get caught in these nets. The objective, as I said, there are a lot of cases where with the proper structuring, the right different pieces, etc., you can meaningfully reduce, maybe eliminate your tax. However, you have to make sure that you do it properly, okay? Very, very important. So in this particular case, what is the issue with going and getting a office lease in that country with this foreign company? Well, essentially that office could now be considered what they call permanent establishment, okay? And even if you say, okay, the foreign company is foreign and all this other stuff, they can then go and say, oh, well, you have this permanent establishment here, therefore a portion of the income of the company is taxable here. And technically it's true that if they can't associate the broad residence of the company with this office, then you'll end up in a situation where they will only tax part of the income of the company. But it's still not good, and it's especially not good because it's very unclear now, well, which portion of the value creation takes place here versus elsewhere? And we may have a dispute with you on that. Go into a whole big, you just don't want to go down that road, okay? So there's a proper way to do that, where you kind of separate out companies and you clearly isolate what income occurs where, and therefore you're going to be taxable in this country on this portion of the income, but the rest of the income won't be taxable, and so on and so forth. And there's ways you can structure transactions and agreements, etc. So it's very doable, but you want to make sure you do it properly. And when you are setting up a foreign company, okay, please, you're setting up a foreign company, do not get local offices, local leases, local any of that stuff in high tax countries. That's basically it. Create a separation. If you want kind of details, you want to go through, okay, hey, here's my situation and how should I work for that? By all means, reach out to us, have a conversation. We can kind of help you navigate it. But I see all too often that people don't really understand what they're getting themselves into, and they can end up in a situation where they think, oh, hey, this is cool because I'll run it through as a business expense, and all of a sudden it may tie them into a place where they didn't intend to get tied into, and that can cause a lot of issues. So I hope that helps. If you have questions, put them in the comments below. Otherwise, feel free to reach out to us. I will look forward to seeing you on the next video.